Understanding the basics: inflation, interest rates, and the stock market. Inflation is the rate at which prices for goods and services increase over time. When prices rise, our purchasing power decreases, meaning we can buy less with the same amount of money. Interest rates are the cost of borrowing money. When interest rates are high, borrowing becomes more expensive, which can slow down economic growth. The stock market is a marketplace where stocks or shares of ownership in publicly traded companies are bought and sold. The stock market is influenced by a variety of factors, including economic growth, corporate profits, and interest rates. These three economic forces are intricately linked and have a significant impact on our financial lives. Understanding their dynamics is crucial for making informed investment decisions. Inflation erodes the value of money over time, while interest rates represent the cost of borrowing. The stock market, reflecting investor sentiment and economic expectations, is influenced by both. When inflation is high, central banks often raise interest rates to curb spending and control price increases. Higher interest rates make it more expensive for businesses to borrow money, potentially slowing down economic growth and impacting corporate profits. Additionally, higher rates can make bonds more attractive to investors seeking stable returns, potentially diverting funds away from the stock market. The current landscape, 2023 in review. In 2023, we witnessed a turbulent economic environment. Inflation remained persistent, driven by supply chain disruptions, geopolitical tensions, and strong consumer demand. Central banks around the world responded by raising interest rates, attempting to rein in inflation. These rate hikes impacted the stock market, as investors grappled with uncertainty about future economic growth prospects. The year 2023 served as a reminder of the interconnectedness of inflation, interest rates, and the stock market, highlighting the challenges faced by policymakers and investors alike. As we approach 2025, the economic outlook remains uncertain. Inflation, while showing signs of moderation, continues to be a concern. The cumulative effect of interest rate hikes is yet to be fully realized, and its impact on economic growth is still being assessed. Looking ahead, predictions for 2025. Predicting the future of the economy is inherently complex and subject to various factors. However, based on current trends and historical data, we can make some educated guesses about what 2025 might hold for inflation, interest rates, and the stock market. Inflation is expected to moderate but remain above pre-pandemic levels. Supply chain bottlenecks are easing and consumer demand is gradually slowing down due to the cumulative effect of interest rate increases. Central banks are projected to maintain a hawkish stance, keeping interest rates at elevated levels to ensure that inflation is brought under control. This environment of moderate inflation and higher interest rates will likely impact the stock market. While economic growth may slow, corporate earnings are expected to remain resilient, supported by continued consumer spending and business investment. The stock market is likely to experience volatility as investors adjust to the new normal of higher interest rates and moderate inflation. Navigating the markets in 2025. Guidance for individual investors. In this complex and uncertain environment, it is crucial for individual investors to approach the market with caution and a long-term perspective. Diversification remains key to mitigating risk. Allocate your investments across different asset classes, including stocks, bonds, and real estate, to reduce the impact of volatility in any one sector. Consider investing in companies with strong fundamentals such as solid earnings growth, low debt levels, and a history of paying dividends. These companies are better positioned to weather economic downturns and provide consistent returns over time. Remember that investing is a marathon, not a sprint. Don't panic sell based on short-term market fluctuations. Instead, focus on your long-term financial goals and stay invested, even during periods of volatility.